Hello everyone, welcome to SFC Markets Exclusive. Amidst global challenges, we see China's economy stands resilient. Will it continue to play a pivotal role in driving the global recovery? And with major central banks pausing rate hikes, what's next for global markets? With those questions in mind, we are privileged to be joined by Steve Brice, Global Chief Investment Officer at Standard Chartered Bank. Welcome, Steve. And let's dive in. What's your take on the projected weaker global growth this year, and what's behind it?
Yeah, so from our perspective, we agree with the outlook for global growth to slow this year. Obviously, if we look at the three major regions, we think the key driver of that slower growth is actually going to be for the US economy. We're looking at the consumer in particular, where we see signs of forthcoming weakness. Obviously, the recent data has been pretty strong. But just in the big picture, we're looking at around 1.5% growth in the US this year versus 2.5 last year. Whereas obviously in China, growth is expected to be relatively resilient. I'm sure we'll talk about that a bit later. But also in Europe, obviously bordering on recession at the moment. Unlikely to deteriorate dramatically from here. We do expect policy easing to come through later in the year, but unlikely to be a major driver of growth either. So the main difference between last year and this year, in our opinion, will be slower growth in the US.
The US economy seems to be resilient last year. Why? And what's your expectation for the US this year?
Yeah, so I guess everybody was entering 2023 expecting a recession in the US, and obviously the economy held up pretty well. If we look at our recession indicators, actually they're still flagging risks of a recession later in the year. But our central scenario at the moment is that, yes, we'll see slower growth, but it's less likely to be a recession. And I think the key thing to watch here is obviously investment last year, was very strong. And that's likely to remain relatively strong, I think, this year as well, although election uncertainty might undermine that to some extent. But the consumer is where the key change is going to come, in our opinion. So excess savings have been dwindling, so down to around $400 billion now. That's still relatively healthy, of course, but that's likely to be more and more decline more and more as we go through this year. And we obviously looking at the labour market as well, as everybody is. If we look at the headline jobs numbers, of course, it looks incredibly strong, and almost booming from a labour market perspective. But if you look under the hood, I think from our perspective, we're seeing that hours worked is starting to decline quite significantly. And that's often a lead indicator of future demand for workers. So even a 0.1, and we actually last time we saw a 0.2 decline in the number of average hours worked. Even a 0.1 is actually quite material. So we've seen that starting to decline again. So we expect the labour market to weaken from pretty strong levels, but to weaken as we go through the year. And that's going to lead to, we think, slower wage growth and therefore a little less willingness to go out and spend excessively as we go through this year. So that's really where we see that slower growth coming from.
How about the China's economy?
The retail sector is still a major positive for us. It's just continuing consumers continuing to spend. So that's a major driver of most economies, and China's no exception to that. Obviously, we're seeing inflation still very low. That means the authorities have plenty scope to stimulate the economy if they want to, and try and to help that bottom out and lead to stronger nominal growth, which is absolutely critical to the Chinese economy. Look, I think it's a really, really exciting area. Obviously, up the technology chain, both whether you're talking about hardware, whether you're talking about software or technological services, and financial services as well. I think this is going to be absolutely critical to the success of the Chinese economy. So I think it's really exciting. They're making huge progress already. Obviously, certain companies from the region are huge companies already, and we're going to see more of those develop. So I think from an economic perspective, going to be a key driver for driving long-term growth, but also for stock market value as well, and stock market investors. I think the region is going to be increasingly important. Obviously, the Silicon Valley type part of China. So, yeah, very exciting. And obviously, we're watching this space, but I think it's going to be really good for the economy.
We have seen decline in inflation during 2023 across the world. Are the inflation risks diminishing?
So I guess there's different dynamics in different countries. So from our perspective in the US, we obviously saw a very significant deceleration in inflation last year. That was primarily driven by goods prices coming lower. We think the batton's going to shift over to services prices this year. So obviously the deceleration is not going to be as dramatic as we saw last year, but still drifting lower. So that's a positive outcome. I think in Europe, actually, it's likely the deceleration is likely to accelerate this year, if that makes sense. So coming down faster. From where it was, it's been pretty sticky so far, and so that's going to be a major driver of I think policy, financial markets as we go through this year. I guess the only caveat that we just need to keep an eye on is the Middle East conflict. We've obviously seen the Red Sea now becoming almost closed to trade. And around 12% of global trade goes through that. Historically, has gone through that route. So rerouting that via the southern tip of Africa is obviously much more costly, takes more time, and will lead to delays in goods being delivered. So obviously, if people are harking back to COVID and sort of saying, supply chain disruptions, that could be really worrying. I think from our perspective, it's probably manageable, but it's still a risk worth watching. And for me, oil prices is the key. So far, oil prices have been very well behaved through the regional conflict. If that remains the case, then the disinflation trend continues. But obviously, if we see oil prices go above $120 a barrel or something like that, then that would lead the market to totally reevaluate the short-term interest rate inflation outlook at least.
Given the current economic situation, how soon and how quickly you think central banks, particularly the Fed and the ECB, should cut rates? And what potential impact could this have on the global economy?
Yeah, so I think from our perspective, the Fed is likely to start cutting only in June. So I know there's been a lot of speculation in markets, which has obviously been pushed back a little bit now, but people were anticipating a March rate cut. Our sense is that will come only in June. Look, the economy today still looks relatively robust, right? So from the Fed's perspective, they say, yes, inflation's coming down, but we've got this Middle East tensions and potential for an inflation shock coming from there. They really want to avoid what happened in the 1970s when they got inflation virtually under control, and then we had a second surge. So as long as growth is strong, I think it makes it easier for them to stay on hold. But as the economy weakens through the year, and we expect that to say second half to be weaker than the first half, then a forward-looking Fed with higher real interest rates because inflation's come down means they'll have tight monetary policy settings. So they'll probably say, okay, we can take some insurance cuts to start with, starting in June. I think from a Europe perspective, they'll probably be a little bit further out. They have a harder conversation because growth is weaker, but inflation is already higher. And historically, the ECB has generally, obviously influenced by the old Bundesbank from Germany, has generally been a bit more hawkish than the Fed. So from our perspective, they're probably only likely to start cutting rates in the second half of the year, despite that economic weakness that we're seeing.
So besides the Fed and other central banks' moves, what other key factors will impact the performance of equity markets this year?
Yeah, so I guess everybody's focused on the political environment in the States, right? So that's, obviously we're heading into elections. So I think that's going to be a major conversation. Whether it has a big impact on markets, often these things don't have a long-lasting impact, to be honest. I mean, I remember when Trump was elected the first time around, everybody's like going, that's going to be the worst thing for the stock market. And I think the stock market went down for about 2 or 3 hours and then went on a massive bull run. So we shouldn't overplay these things, but I think it will lead to some significant volatility as people try to figure out how the election pans out and what that means for policy. I think the second point is, what does that mean for fiscal policy, right? So we've seen obviously stimulus being implemented by Biden last year. I think that both presidents are likely to pursue, further policy easing if they were to get Biden was to get a second term or Trump was to get a second term. The nature of that would be very different. So one would be more on the spending side, one would be more on the tax side. But again, that can lead to different sectors being seen as beneficiaries of different policies. So again, maybe at the aggregate level, not a huge impact, but could have an impact at the company level.
How do you explain the current correlation between stocks and bonds? In this environment, what investment advice do you have for stocks and bonds?
Yeah, so I guess the way that we look at this is in periods of high inflation. So typically when inflation is above 3% in the US, you on average have a positive bond equity correlation. So if bonds are doing well, equities are doing well, and vice versa. And obviously 2022 was the epitome of how painful that can be for investors, right? When bond yields in face of an inflation shock went through the roof and stock markets went through the floor. So that's clearly a challenging environment. The way we've been looking at it this year is saying, well, yes, we still think we're going to get a positive equity bond correlation, at least in the beginning of the year, because inflation is still relatively elevated. But this time it could be a tailwind. So the theme for our investment 2024 outlook is sailing with the wind, right? Because we see inflation coming down, we see interest rates coming down ultimately, and therefore we see both bonds and equities at least starting the year on a positive note. Now, bonds obviously have sold off a little bit, but we're increasing our allocation to high quality bonds at the moment. We have already done that again this year. So we're not too concerned about, this 60-40 equity bond portfolio that a lot of people are writing off. I think there's two things there. One is actually it could do quite well in the short term, and that's been the experience we've seen so far this year. But secondly, yes, of course, you should diversify into other asset classes, whether that be gold. You should have a cash allocation on the sidelines as well, and then look at alternative investments where available to sort of hedge inflation risk or other volatility that bond equities may struggle to hedge against. And obviously, the real risk is stagflation. So, be diversified across as many asset classes as you can. To try and smoothen out the investment ride from a return perspective.
So, with what you just said, what's your view on the performance of global stocks market this year? Are equity valuations becoming more attractive this year?
So, I mean, I guess if you're looking at global equities, the obvious place to start is the US, given the heavy weight in the global indices. We expect the US to start on a strong note, and indeed we've seen that, right? We are a little bit cautious extrapolating that strong performance through the whole year at this point. And the reason is because we believe there is still a risk of a recession. I mentioned the indicators earlier. We have 14 indicators that we look at that sort of talk about whether they sort of highlight whether there's a heightened risk of recession or not. And 10 of those 14 are still saying there's a heightened risk of recession, right? So we have a 30% probability of a recession in the US this year, and we think that probability is more tilted towards the second half of the year. So the way we're positioned, we're overweight US equities, and we're overweight global equities, but we have trimmed back that overweight because we actually think valuations there are getting a bit expensive. So from our perspective, it's not. I think we have a situation in the market where we have strong performing markets that are expensive, and we have weak performing markets that are very cheap, and it's just trying to balance the allocations that we have to those. But we are overweight US equities at this point.
Which sectors would you say are better positioned in the current economic backdrop? Any advice or strategy for investors?
Yeah, so from our perspective, I think from an equity market perspective, the sector point, we have a barbell approach. So because we're expecting interest rates to come down and growth to come down, we're sort of saying, okay, which are the areas that are more beneficial from lower growth, or at least more resilient to slower growth? And which are going to benefit from lower interest rates as well. So clearly on the more pro-risk side, technology and communication services are two sectors we like. They are both more resilient to growth slowing and also benefit from lower interest rates. On the other side, much more defensive, we have an overweight to healthcare as well. Again, they generally have much more stable earnings through the economic cycle. Less beneficent, they don't get as much benefit, of course, from lower interest rates. But, if we did get an environment where growth was to slow significantly and inflation was to be elevated, then healthcare would probably be a good hedge to your portfolio.
Do you think investors can look outside the US, for instance, consider Asian equity exposure?
Yeah, so we would always suggest that people are diversified across different asset classes, different regions, different risk type of assets as well. So in bonds, yes, we're overweight investment grade bonds at the moment, but we still have an allocation to high yield bonds because nobody knows for sure what's going to happen. As far as Asia ex-Japan equities is concerned, we have around 11% allocation in our growth portfolio to Asia ex-Japan equities. So we have that as a neutral allocation to us. So it's not a preference, but we obviously have significant growth opportunities in these markets. So whether you're looking at India is obviously a very positive growth story and a structural one. ASEAN as well, and China. Let's not forget that if we're saying US was resilient at 2.5% growth last year, and China, is still outpacing what we see globally, right? So very strong growth driver. So from that perspective, now we have some markets that are very expensive. So India is very expensive. So it's almost pricing that strong growth story. And then obviously at the other extreme, we've got Chinese equities, which are still pretty cheap. So from our perspective, that 10% plus allocation to Asia ex-Japan in the current environment balances out all of these positives and negatives for the region.
Can you further elaborate on the outlook of China's stock markets this year?
Yeah, so I think from our perspective, we have a neutral allocation to Chinese equities, which in a growth portfolio is around 3-4% allocation, right? So it's a decent sized allocation. Just to put that in context, Japan, which we have an overweight allocation, is also a 4% allocation. So it gives you a sense of the positioning. I think obviously valuations are very cheap. Right, so that is a massive positive. They were cheap at the end of last year. They've obviously cheapened this year. And from our perspective, we're saying sentiment seems so negative at the moment that it probably wouldn't take much for the market to do well. So I think the overall story is yes, there's some challenges on the economic side as well. But given how oversold markets have been and how bearish sentiment is, I think having an underweight allocation to Chinese equities is really dangerous because we know when Chinese equities rally, they can rally very, very quickly and very sizably. So that's why we wouldn't have an underweight allocation despite the bearishness in the market. I think one thing that we would love to see is inflation starting to turn around and moving higher. Obviously, when you've got deflation, people will talk about that as a concern for the economy, for debt management, for corporate earnings growth. So if we were to see inflation bottom out and move sustainably higher towards, say, 2%, I think that would be a massive alleviation of a negative from a sentiment perspective. And that's something that could lead to a very strong market rally in China.
Thank you, Steve.
Thank you so much for your time.
As Steve points out, the slowdown in global growth this year will be primarily influenced by the slow growth in the US, whereas China's growth is expected to be more resilient. That's all for today's show. Thank you for watching. See you.